The dust has settled somewhat after the presentation of the Union Budget 2020. And we've had some time to read the finance bill and to look at the changes that affect you and me beyond the headline that's already been spoken about so much, which is the introduction of the new income tax regime. We've compiled a list of the major changes that you need to know about so that you can get your planning for the new year done nice and early. First, let's get the headline out of the way. We've already taken you through the major aspects of the new income tax regime. It's optional, it comes with lower tax rates, but if you're opting for it, you'll have to give up most of your exemptions and deductions. And while there are a few exemptions that remain in the new regime, all of the more common ones will be unavailable. In several instances, particularly if you're a salaried employee, this means that you'd pay more tax under the new regime. So sit with a chartered accountant or a financial advisor, or if you're able to, simply do the math yourself and figure out what's best for you. It is somewhat subjective in that sense. Now, let's move on to the other changes that could have perhaps slipped below the radar on Saturday. The biggest change from the perspective of an investor is the scrapping of the dividend distribution tax, where presently companies and mutual funds distributing dividends have to pay a tax of around 20%. Starting next year, the tax will be levied on those receiving the dividend. So, who do you receive dividends from typically? Well, you receive them from companies in which you own equity, from mutual fund schemes that distribute profits through dividends, and from real estate investment trusts and infrastructure investment trusts. Here's how it will work going forward. The company or the mutual fund deducts 10% tax at the source when they pay you a dividend. The dividend income then goes and sits on top of your annual income. And depending on how much your annual income is, the dividend that you receive can fall into any one of the tax slabs that are used to calculate your income tax. So, for example, assume your annual income next year is 4 lakh rupees and you receive a dividend income through the year of 1 lakh rupees. At the end of the year, because your income of 5 lakh rupees is essentially tax-free, you'll be able to claim a refund of the 10% tax that was deducted at the source. Now, if your dividend income pushes you into the newly created 10% tax slab, there's no refund to claim because that tax has already been paid through the TDS. But if your dividend income pushes you into the higher tax bracket, say for example the 30% bracket, you're liable to pay the difference in the tax, which in this case is 20%. So as an investor in a mutual fund scheme or schemes, if you find that you're liable to pay tax at the highest rate, you might want to consider the growth option, in which you'll have to pay long-term capital gains tax on equity at 10% plus cess after a year, and long-term capital gains with indexation benefits for debt after 3 years. Moving on from dividends, there was a change relating to the calculation of long-term capital gains on the sale of property. Earlier, there was a benefit of 5% on the sale price that was given for the calculation of capital gains. What that means is that if the price at which the property is sold is up to 5% less than the ready reckoner rate or the circle rate, then the lower value, that is the market price, is used to determine capital gains and the tax payable. The ready reckoner rate or the circle rate, remember, is what the government uses to calculate stamp duty. Now, because of how real estate prices have moved over the past few years, in some cases, the market price of the property is lower than the circle rate. In this budget, the benefit was increased from 5% to 10%, and that is a positive development. Next up is ESOPs, or employee stock options, for those that work for startups. It's a common way to reward employees for joining up, and globally it's known as sweat capital. Now, ESOPs are taxed at 2 levels. The first is as income from salary at the time when those stock options are exercised, and then as capital gains when the shares are sold. Now, in the budget, the finance minister announced that the first tax, that is when the stock options are exercised, will not be levied for 5 years, starting from the year that they are exercised, if the employee stays with the same organization. It is payable only when the employee leaves or the shares are sold. Now, tax experts have said that this is a benefit for those who intend to stay with the company for a decent amount of time from the perspective of managing cash flows. Remember, but you still have to pay this tax, just not as soon as you've exercised the options. Now, the next change only pertains to the high earners. The government noticed that while there are individual limits to the tax-free contributions by an employer to the National Pension Scheme, the Superannuation Fund and the Provident Fund, there isn't a joint limit. And as a result, at high income levels, people were structuring their salaries to have no tax on a sizable amount of money. To plug that gap, the government has now said that the combined limit for an employer's contribution to all of those three will be 7.5 lakh rupees, and any amount over that will be taxed as perquisites. Now, the Finance Minister has also announced a new rule that is an attempt to discourage those attempting to escape paying tax in India by moving abroad and getting the tag of non-resident. Now, a person will be declared as being a resident if they spend 120 days in the country, as opposed to the earlier rule that stated it was 182 days. And that more or less covers all of the major changes. If you've got any questions about them, do let us know in the comment section, or you can write to us on any one of our social media platforms. Thanks so much for watching. This is Bloomberg Quint.